I think we'll start. Good afternoon to all of you. And, I'm René Carsanti. I'm from ICMA, the International Capital Market Association. And thank you for participating at this event on climate resilient debt clauses. This event will explore the role for CRDCs in supporting the financial resilience of vulnerable countries in the face of severe shocks, and the scope for developing and including them in debt held by private bilateral and multilateral creditors. We are very fortunate to have Minister James Cartledge present here, who will address the audience. Minister Cartledge was appointed the Exchequer Secretary to the Treasury on the 28th of October, quite recently. He was previously parliamentary under Secretary of State at the Ministry of Justice and Assistant Government Whip between September of last year and July, 7th of July. Minister, the floor is yours.
Thank you so much, and thank you to the panel for coming and for all of you for providing. Well, this is a fantastic venue. I did speak earlier. We had some audio issues, but this time the microphone, I think, is working. So I'm getting a nod right in the corner, so that's very promising. So my apologies, I will be leaving afterwards. I've noticed this is quite common at this event, but it doesn't mean this isn't important. On the contrary, this is a really important announcement. Look, you all know the situation. Many countries are facing daunting debt challenges as a result of the compound shocks of the pandemic, Russia's invasion of Ukraine, and of course climate change. So we meet today in what are incredibly challenging times. And let me be clear, the UK is fully committed to providing debt relief and restructuring where countries need it, including through the G20 Common Framework. So developing countries' growing debt challenges raise a serious question. Does the international financial system currently have all the tools it needs to support those countries most vulnerable to external shocks? This is a massive question. In the past, crises have spurred new innovations, such as the Latin American debt crisis of the 1980s, which was ultimately solved when illiquid bank loans were turned into tradable Brady bonds. Today we're hearing many countries, including through the Bridgetown agenda led by Barbados Prime Minister Mia Mottley, and got her advisor here today, which is fantastic, calling for reform to be made to the international system, including the introduction of climate-resilient debt clauses in loan agreements to help absorb shocks. Whether it's the floods in Pakistan, the drought in the Horn of Africa, or Hurricane Ian in the Caribbean, natural disasters that result from climate change are growing more frequent and more severe. When a country faces a climate shock, it needs all the financial resources available directed at response and recovery. Yet climate-vulnerable countries often face the impossible choice between funding disaster relief and meeting their financial commitments. It's a very difficult position. If the numbers don't stack up, if countries can't service debt and respond to the crisis, then climate shocks can quickly become debt crises. Climate-resilient debt clauses could help break this link. And we have seen growing calls from developing countries at the Climate and Development Ministers meeting in September, as well as during the IMF and World Bank annual meetings in October, for further development and uptake of these clauses. By contractually providing for suspending and rescheduling of debt repayments in the event of predefined shocks, CRDCs can provide vital fiscal space that benefits the borrowing country and its lenders. They can form an important layer of a country's disaster risk management strategy, complementing other financial tools such as contingent credit lines and additional crisis finance. Now, we know this is doable, and that is why the UK established a private sector working group to explore, with the help of the private sector, fellow official bilateral creditors and IFIs, how to take this work to the next stage. We think that building these climate resilient debt clauses up front into the loan agreements of a wide range of creditors would overcome the barriers to providing flexibility. So we therefore want creditors across the private, official, bilateral and multilateral sector to explore adopting these clauses to build a layer of resilience into their lending, particularly given the realities of climate change. We know the appetite is there. We have heard many countries, especially small island states like Barbados and low-income countries, calling for these clauses during the UK's COP presidency. And I know we're going to hear from Barbados shortly on why they've incorporated a natural disaster clause into, I believe, their recent debt issuance, obviously very important. We'll also hear from the Inter-American Development Bank. The IDB is well ahead of its peers by already offering a form of climate-resilient debt clause in its lending to countries. Indeed, building on IADB's leadership on CRDCs, I am pleased to hear that the multilateral development banks have agreed to form an informal working group to further explore CRDCs and other approaches. So there's a lot happening. But we, as the UK, are also determined to walk the talk on this. And that is why I'm delighted to confirm that our export credit agency, UK Export Finance, will today become the first export credit agency in the world to announce that it will offer climate clauses into its direct sovereign lending to low-income countries and small island developing states. Now, private lenders must also play a leading role in this, given their scale. As a recent world publication noted, at the end of 2020, low and middle-income countries owed 5 times as much to creditors as they did to bilateral creditors. That is why I'm excited to see HSBC here today. Shout out for the bank, come on. They, along with other creditors, have been participating in the UK-chaired private sector working group to look at how CRDCs can be applied in private sector lending. I'm pleased to announce important progress on this work today with the publication of an updated model term sheet detailing the main elements to underpin design of these instruments. Further discussions will be needed to define in more detail how these clauses will be activated in specific cases, and sovereign borrowers will have to determine how best to tailor these to their needs. But we are pleased to have reached a significant milestone in this work. All this, on top of the work by the private sector working group on the introduction of majority voting provisions in syndicated loans, specimen clauses which have also been published, should help build resilience, provide fiscal space in the event of disaster, and strengthen debt sustainability in low-income countries. Before I finish, I want to address climate vulnerable countries directly. I know it can seem that people are enjoying their lives in the global north while someone here is paying the price, but we're in this together. And I just make a personal point. This is not in my speech, by the way. I had my honeymoon in Sri Lanka, 2004, Boxing Day. I was on the beach in tsunami when it hit. And so I've seen the impact. Now, whether the tsunami was a climate event, the point is it is a traumatic experience for a country, and the people of Sri Lanka were hit so hard in all many ways. So I think this is incredibly important. We could not take our commitment to net zero and tackling climate change more seriously, but it's about what it does in reality. Because if a country is in that situation, it's a crisis most of us would never imagine, right? So I think this is incredibly important. I hope the steps I've outlined today show this clearly to all of you, and I thank you for your support and all the work to help deliver it.
Thank you very much to Minister Cartledge for this important and most pertinent introduction to CRDC. We are also pleased to note the key announcement the Minister has just made in relation with CRDC, also in relation to the export finance and the model private sector term sheet. We'll have an opportunity to discuss that in more detail. We are almost grateful to the UK leadership on this subject. The UK established the private sector working group in 2021, chaired by HMT. The group brings together international financial institutions, including the IMF, the World Bank, G7 countries, and the private sector, including major US and European banks and investment firms, legal and financial advisors, as well as academic experts. ICMA is honored to be part of it. While CRDC have already been introduced into a small number of bond issuance and loans, these have been limited in scope and geography. And indeed, the working group noted increasing calls for such mechanisms for climate vulnerable countries. For example, in the COP negotiation and the Bridgetown agenda as a way of improving resilience to shocks, as well as by other organizations, including UNDP and UNICE. The working group agreed there was merit in the further design and uptake of the CRDC, and has therefore explored and now developed and designed the new terms model, the model terms, that provide for deferral of sovereign debt repayment to private creditor for a pre-agreed period. This built on the previous work by the IMF, ICMA, as well as Clifford Chance under the Canadian G7 presidency in 2018. As the objective of the event is to explore the role of these particular clauses for all creditor types and how they could be implemented, we are most fortunate, as the minister said, that we have experts representing those categories from different creditor types. Barbados, represented by Professor Avinash Persaud, Special Envoy to Prime Minister of Barbados, a multilateral development bank, the Inter-American Development Bank, represented by Mr. Benigno Lopez Benitez, Vice President for Sectors and Knowledge. We have also a leading private sector bank, Mr. Alexei Chan, Head of Global Banking Sustainability of HSBC. And last but not least, the UK Export Finance is represented here by his director, Tim Reed. Unfortunately, as you can see, we do not have in this session a gender-balanced panel, but we welcome the range of voices and perspectives representing through the panelists, government, MDB, private sector, and official creditor. We live in a world where countries are vulnerable to both growing debt levels and increasing risk of climatic shocks. If sovereign borrowers can avoid default at the time of a natural catastrophe, this will benefit both affected countries but also the global financial system. Our objective of the working group, one objective of the working group was also to extend the CRDC beyond the Caribbean to a wider range of geographies, including the Pacific, Africa, Central, and Southeast Asia. We'll get into more detail during our panel. There are various features and issues we will have a chance to explore further. And now, without delay, I would like to turn to our panelists and benefit from their experience. First, I would like to ask a question. You are not surprised, Professor Persaud. Why are, who is a representative of Barbados, why are CRDCs needed? What has Barbados' experience been with these clauses?
Thank you very much. And, you know, Barbados is the tiny Barbados is the world's largest issuer of sovereign bonds with natural disaster clauses, which happened in 2018. And we're now this year the first sovereign issuer of bonds with pandemic clauses. So our new bonds have natural disaster and pandemic clauses. Now, it was easier for us because we did it during a debt restructuring. So we were able to shift all the debt in the exchange with a new bond. Now, I think there are three reasons to answer your question and why I think this is actually much more impactful than many people appreciate. There are 5 proposals in the Bridgetown Initiative. This is one of them, but I think it's as impactful as the others. It's probably the least sexy, but as impactful. And why is that? Well, firstly, this is not insurance. Insurance has a role to play in the world. Cat bonds have a role to play in the world. But for climate risks on the front line, that's an uninsurable risk. If you want to use insurance, you want to have something where there's uncertainty on the incidence, where over time it's not rising a risk relative to other risks, and it's uncorrelated. Well, that's the opposite to climate change. So rising risk, rising correlation, increasingly certain of its incidence. And so we're already finding insurers are pulling away from offering that kind of insurance. So this is NPV neutral, is the most important aspect of this instrument. Creditors are no worse off if the event takes place. The second most important aspect is scale. When a natural disaster hits Barbados, we have instant release of 18% of GDP. There is no instrument in the world today that comes close. Our dear friends at the IDB offered us a contingent credit facility capped at 2% of GDP, and that's what you would expect from the development banks. That's where they are roughly on these instruments. 18% of GDP. If every developing country had them during COVID, it would have released $1 trillion of liquidity to fight the COVID crisis. And you know how much they spent on COVID? $500 billion. So this could have tripled their impact. And the final thing to say is that it's automatic. And this is something that I didn't appreciate. You know, I grew up in the UK. I was born in Barbados, grew up in the UK. And before I arrived back in a developing country, when a crisis hits, you do not want to take your leading team away from the crisis off to DC to start negotiating on how you deal with your debt instruments. The automaticity of it is really very important. And take Pakistan, poor Pakistan today. I mean, if you're a creditor, you're there thinking, what are they going to do? They've had such a major disaster, they may default. The certainty of it is, I think, so important. And that's why when we issued them, it actually had no impact on the pricing of our bonds. If anything, our bonds began trading at a premium, over par. And we think that's because it produced greater certainty amongst the creditors. Thank you.
Thank you very much, Avinash. And really, you have been leading the way with this first transaction, on which we are building on a more general and model terms. Thank you very much. I would like to ask a question to Mr. Lopez Benitez from the IADB. You are currently the only MDB to offer CRDC type of clauses through your principal payment option. Could you tell us what that offer is and how it fits your contingency credit offer? What demand has there been so far for these, and what has IADB experience been so far?
Thank you. Thank you very much for the question. It's a pleasure for me to be here and share the IDB work on these issues over the last years. As a IDB regional, more important partner of the region, we know how the countries suffer when they have a risk. We have developed some tools to try to fight this issue. Among them, I can cite you that we have, with the country, we design a disaster risk management profile, so we know what to expect when a situation arises. Then we have a CCF, a contingent credit facility for natural disaster emergencies. It's an instrument that the country signed with us in order to receive assistance from us, and where all the triggers for other instruments are designed and have to be specified in that. Also, we have a major response facility for emergency costs for disaster that the country can apply after the disaster occurs, and we also deploy financing to them. We also have a disaster and climate change risk assessment methodology in which we design and try to understand what the country is happening, what happening to the country, and how we most can help them in order to fight the situation. And we have the PPO, the principal payment option, which we know as the hurricane clause, that the country can apply to that if he has a CCF. So if the disaster is designed and somehow described in the instrument, and that happens, that is what happened with Barbados and other countries, you can apply to that, and we give you the facility that we don't demand the payment of principal for over 2 years, so you can decide what to do with that in order to assess the situation. And that is a most useful instrument, as it happened to be in Barbados, as just was explained. So that instrument is a key in order to fight that. We are also requesting or offering the countries to have that clause in every contract that they have. We have now contract around $2.6 billion with that clause. So if the situation arises, the country will be prepared, so we are.
Thank you very much, and I'm very pleased to see that this multilateral development bank like you has been active in it, also on a personal basis, because I am a member of the G20 panel on capital adequacy framework and trying ways to boost the financing through the MDBs. And I think you have been creative, and we are grateful for that. Alexis, your bank has participated in the working group, and we are very grateful for that, and helped to develop the model term sheet for private lending. Can you tell us about that and how you see this being taken up and used in private bonds and loans, please?
Well, thank you very much. And let me start to the UK government. The other mic. The other mic. Congratulations to the UK Treasury and government for their leadership on this important and very helpful initiative. HSBC, as a major underwriter of sovereign bonds globally, has been really pleased to play our part in the working group, which I think has made significant progress, culminating so far today with the publication. Why is this initiative important? Some of you are struggling to hear me. Why is this initiative important? Here at COP on Finance Day, we're looking at a number of agendas to support the financial impact of climate change, a rewiring of the global financial system. What's clear from all the initiatives I think that have been discussed today is there is no single silver bullet. We need to have a variety of approaches that can help different types of entity, different sovereign borrowers in the market. And so I think this is an important way to help countries hit by climate emergencies. Clearly those countries that are on lower income and are more vulnerable will suffer most as the effects of climate change become more severe. And so it is right both in the short term and the long term that we have an instrument like this to provide support. I'd like to thank my colleague from Barbados for sharing these very insightful thoughts about their experiences with the clauses so far in some of the borrowings that they've carried out. From my perspective, for an initiative like this to be successful, it's very important that we have participation from both public sector and private sector. So it's great to see the range of views expressed on this panel. That can make life more complex to have public and private sector involved playing their part. But our experience with other mechanisms, working with ICMA, including collective action clauses over a period of many years, has shown that with well thought through approaches, we can see widespread adoption of clauses like this. So for broader adoption, I would like to share two thoughts with our esteemed audience today. First, I think the value of having an effective standard or template that market participants can refer to can't be overstated. And so I think the new model term sheet provides a really strong template for future debt to include such clauses, for sovereign borrowers to consider how best they want to work with that model term sheet to structure that to meet their own needs. As with many new concepts in the financial markets, a single set of guiding principles is absolutely key for market transparency. And secondly, I think what's really important is that CRDCs can be embedded in a broader ecosystem that will drive broader adoption. So I think we have many representatives in the ecosystem represented here today. Others will need to play their part as well. Rating agencies, for example, will need to understand how these clauses work, your point about them being NPV neutral, and perhaps adjust their standard methodologies to take into account these clauses as well. Lots of innovation has been discussed today here at COP. This is one excellent example, and we look forward to continuing the work to support its development.
Thank you very much, Alexis. And you're right to say that we have to harmonize as much as possible the terms of this particular instrument in order to have active investment in it, as we've seen in other products like green bonds and others. Now my question to Tim. Tim, the minister has just made a very important announcement and very interesting. Can you tell us what this will mean for your institution in practice and how this aligns with your broader climate change strategy?
Yes, of course. Thank you. And thank you to my fellow panelists. Some great observations already, and it feels like we're already largely on the same page, which is great to hear. I think from where we sit as the UK's export credit agency, we are extremely committed to changing our approach and moving away from the impact that we've had on climate change. And we've been very public about those statements and what we're trying to do about that. We're very determined to help the global transition, support the transition away from the carbon economy, and to help where we can in achieving those objectives. But the world has already and will continue to face climate impacts. We see that more often than we'd like. And this is most acute in the most vulnerable of countries around the world. Advancing climate change resilience is a key UK government priority and one that aligns with UKEF's own mission to support UK exports sustainably. So as the Minister has already said, and I'm going to repeat, we are today announcing that we will, from our next financial year, offer low-income countries and small island developing states the ability to access repayment deferrals in the event of a severe climate shock or crisis. For us, this is really important because I think it allows those countries to prioritize their spending for disaster relief and recovery by pausing principal and interest repayments, and allow them to focus on the issues that are most important as these climate events manifest themselves. This option will be embedded into our financing agreements, so it will be, the mechanism will be in place, it'll be clear what will happen. It will essentially give deferred principal and interest for 1 year, then a 1 year grace period, and then 5 years to repay that, that principal and interest. As we've talked about, it is net present value constant, so the lenders will get repaid in full. That will just be rescheduled over a period of time with a grace period to allow for that money to be spent in the right way. I was going to encourage other creditors to think about this, but it sounds like hearing from the panel that we're already a long way down that road, which is really great to hear. But I think to comment on what some of the panelists have already said, it's going to be really important that we have a consistency of approach here. It's only when we have a consistency approach across a range of creditors that this can be most impactful to the borrowers who need it most in their time of need. In addition, this aligns with Egypt's presidency of COP, supporting those that are most vulnerable. And I think that's also important today as well, and absolutely consistent with the principles that we've all been hearing about while we've been here in Sharm el-Sheikh. Was that me? I think for us this is a very important initiative. It's part of our broader initiative to support clean growth, to support projects that can help economies transitioning, but in this instance to give countries some breathing space at the time of a climate disaster.
Thank you very much, Tim. Congratulations on your bold initiative. Most appreciated. Most appreciated. I have a general question to the panelists regarding regarding these particular terms. What specific aspects of the clause that are important for you, and you will identify, for example, the trigger? Is it the trigger? Is it the loan maturity extension? Whether there are additional requirements? I would like to have your views. These are we had long debates in the working group, and I think it's interesting to hear from you about what you feel is most important. And starting with you, maybe, and whoever wants to.
Thank you very much. And before I mention the key important ones, I should also say, this has been fantastic that the UK we're very excited that the UK has grasped this baton and is running with it and championing this. But it's also important to thank the two people who helped develop those clauses to begin with, which is Sebastian Espinoza and David Nagoski. And I think Sebastian's on your working party and has been part of helping to develop this new model. But I think a key thing has been the trigger. We've got to make sure the trigger is independent. So the country can't determine the trigger. An independent agency determines that the disaster has happened. Another key issue is the independent agency has to determine the size of the disaster. And that's where we've noticed there have been some issues where at the agency we use, which is the Caribbean Catastrophe Risk Facility, have been a little bit slow sometimes to come back with their calculation. The other sort of thorny issue is the maturity extension. So that makes perfect sense when you're in year 2 of your bond. What happens when you're in year 9 of a 10-year bond and you do the maturity extension? And then thirdly, of course, the key thing is they're NPV neutral, so the creditors are comfortable, and you've got to make sure you make the correct calculation so that really are NPV neutral at different times in the maturity. So those have been the three issues, but I think they're all, I would call, second-order issues. They're all surmountable. They've been surmountable in other instruments. So I really am very excited that we could reach, I think, quite easily a harmonized situation, and we're eager that we start to get more issuers using these instruments. The IDP and the UK export credit, fantastic news. HSBC next.
Yeah, perhaps I can just add a couple of things there, and I think the most important thing for me is really the human impact that this can have when one of these clauses is required, so that the money that is being typically used for debt service can be diverted to help people's livelihoods and potentially saves lives. So I think we should not forget that. That, for me, is absolutely the most important impact here. I think the other positive impact from a country's perspective is that because these clauses will be embedded in the documentation, it potentially leads to a situation where, yes, you get a debt deferral and you don't end up in a situation of potential default. So you get some time to put things right. As we know, for many of these developing countries, access to finance is a critical aspect as they look to develop their economies. And enabling this mechanism to take place and give time and flexibility without needing to restructure the debt, at least at the first stage, is absolutely critical. So I think there is a benefit to the country as well.
Yeah, I may add, and agree totally with my colleague from Barbados, that for us, it's very important to have the trigger very specifically determined in order for the bank to disburse the money. Because when a disaster hits you, you don't know where to go. You don't know what to do. If you are a minister of finance in the time of COVID, you don't have a book who's going to tell you what to do in order to avert the pandemic. So it's very for you as a country to have a way to access to financing. And as the colleague from Barbados said, it was important for them, and it was important for everybody to have the trigger. And as the bank, as the IDB, since we are like a public international bank, it's very important for us to have very clear way to disburse the money so we can help the country in disburse.
I would just add very quickly, for these clauses to be effective, we want them to be embedded in a very wide range of instruments ultimately. And so I would absolutely agree that clarity on the trigger points, full transparency, and the independent evaluation is critical. What no country needs is a debate with its creditors when a climate disaster hits as to whether these clauses have or haven't been triggered. So the greater transparency we have and independence of evaluation, that's going to make these more easily adopted by a much wider range of creditors.
Thank you very much. We heard these are important features and particularly aspect of this feature. I would like to open the discussion to the floor, and I'm very pleased that we have a woman who will ask the first question. That balance a little bit, please.
Thank you. Yeah, just to try and help with the gender balance. It all sounds great, and the added flexibility is clearly very much needed. My question is that you've spoken a lot about sort of the countries that are really facing the most impacts and the sort of highly climate vulnerable. And I'm just wondering, is a 1-year pause in 2 years, but you referred to a 1-year pause? Yeah.
So we referred
Yeah.
to a 1-year sort of moratorium on paying interest and principal, then a 1-year grace period, and then a 5-year period of,
Right.
of rescheduling of that those payments that would have been due.
Okay, so even a 2-year effective sort of pause and then a 5-year repayment, is that going to be enough to shift the needle for low-income countries that are really on the front lines of climate change and that are highly climate vulnerable, given that they're already sort of suffocated by debt, and then you're essentially after the 2-year pause, their repayments would increase to pay back the 2 years of lost time. So I'm just wondering if, for those really on the front lines who are also low-income countries, is this going to really shift the needle for them? Thank you.
Thank you. This is a pertinent question, of course, but it's a contribution to the for the countries for their independence.
So the very low income countries are largely shut out of access to private credit. And they're borrowing from the official lenders and the multilateral agencies. And they may well decide to be more generous than that. But we're talking about the 5 billion people who live in middle-income countries. It's where 62% of the world's poor live. Only 30% of the world's poor, I may say only, but 30% of the world's poor live in the LICs, but 62% of the world's poor live in middle-income countries, and they are shut out of access to concessional money. So they're highly dependent on the private creditor markets. So we have to find something that is NPV neutral and acceptable to the private creditor markets. There's a story in the New York Times about our negotiation of how we got the clauses into our bonds, and it was perhaps the most tough issue of all the issues. The creditors were not initially in favor. Later they became strong supporters. So I think that what I can say is it works. And certainly for us, it's the only thing of that scale. Nothing that we have comes anywhere close.
That's very interesting. And the fact that your pricing and the transaction has traded in a better way than traditional transactions means that the market and investors see in that an enhancement of the creditor, the situation. But it won't solve all the problem. It's a contribution, obviously.
Can I add something? Since we, as the colleague from Barbados said, since we work from public money, because it's the money of the countries that gave us to run the IDB, we should be careful with that. And we found a way. We found a solution for this distress that is working. We can have a conversation later, maybe if it's 3 years, 4 years, it will have a cost. But this solution, as he said correctly, we didn't have with COVID. So you don't have anywhere to go, anyone to cry. You have to invent whatever solution was in order to save life in your country. So I think it's a good first step, maybe more steps in the run.
It really is a great question. And I think when you look at broader market access, it is a balance between giving the country financial support at a time of need and retaining that NPV wholeness and retaining as much, not all countries, as you say, have full market access, but retaining as much market access as possible. So I think my colleagues have talked about this balance. It's a first step. Hopefully it will be a major step forward. But very much appreciate the question.
Thank you. Any?
I was just going to say, add one thing, because I think that balance is important, but what it does do is it gives some time, which I think is important to not be thinking about that on day one. And so it gives time to focus on the disaster in hand rather than focusing on negotiating a debt instrument.
Good point. There's a question here.
Thank you very much. My name is Peter Hilliges with KfW Development Bank. And I was wondering, there are some studies, calculations out there who are saying that countries already pay a spread on their sovereign debt because of their vulnerability. Yeah, I don't know whether you agree to this, yeah, but there are some studies. If this was true, and maybe you already know it, would this mechanism, this debt relief clause, actually shield countries? Yeah, so that they don't have this spread that they are paying right now?
So your question is in relation with pricing, and as I said, the perception we have, your experience, and the experience so far is that it has enhanced a little bit the pricing.
I think there are two aspects to the vulnerability issue. There is the fundamental underlying vulnerability, which it's very hard for you to ultimately get away from paying, from some suffering from and paying from. But what you have in many developing countries, in addition to that, is that when the vulnerability hits you, you have no options. And you therefore, at the worst possible time, are forced to increase your debt. Right? And that's when that vulnerability then is amplified by not having options. What this does, and echoing a bit what Tim was saying, it gives you that option. In those 2 years, you do not need to go to the market when they are very dubious about your situation because you've just been hit. They don't know what's going on. And so it reduces half of the problem. It reduces the thing that a developing country in a crisis has no option. So we've had the biggest increase in developing country debt during COVID because they had no options. They couldn't do quantitative easing. The developed countries did $12 trillion of quantitative easing. Developing countries couldn't do any. So it gives them that option. And I think that reduces then some of the risk. And that's why our spread went down. But it doesn't get you out of the fact that you're still a vulnerable country.
Thank you. I will take one more question, and then, unfortunately, we are pressed by time. Yes.
Hi, thank you so much for the talk. My question goes a little bit in the vein of the first question, which is, are we going far enough, really? But let me try to formulate that a little bit better. We've said kind of multiple times that the last thing you want to be doing kind of in the face of a crisis on that day one is negotiating with your creditors, getting in there and kind of trying to find the right bond, the right loan. And I would argue that in addition to natural disasters, the ecological crises that we're facing, both climate and biodiversity, are crises that developing nations and really the whole world are facing and fighting day to day. So that then it becomes clear that we need to get liquidity to developing countries. They're fighting, developing their economies, as we said, transitioning their economies, lifting their population out of poverty. And then we look at debt, as you said, they don't have a lot of options. And then especially when we look at debt through the historical lens, where debt is largely a result of the colonial and post-colonial period, why are we not going farther? Why are we not calling for things like the eradication of debt for the global south so that they have those options instead of solving half the problem, solving it further?
Thank you. Someone want to address? Avinar.
Look, I'm great that people are calling for that. But if a developing country needs money next year, so I cancel all my debt this year, and I'm going to the market next year for money, I'm not going to get it. So I think it's important that people raise those legitimate justice and moral issues so that we are talking in the right moral space. But the reality is if you're a country that needs international financing, then canceling debt is a problem because you won't get it again next year. So this clause is a great way providing you the liquidity when you need it. Now, there are very poor countries that maybe who borrow from governments who may well decide that cancelling debt is the best thing to do, and governments ought to help them with that.
I may add that, as he said, that this gives you an opportunity. This gives you choice to have a solution fast in a situation that it's not easy to get a solution when you have in a crisis. Then you have many, many, many things to do as a country to solve the other problems that you have, and you have to also go and ask to the development banks and whoever can help you. But without an option, none of the discussion will happen. So we will have almost barriers in debt somewhere.
Thank you. You want to add? No. Thank you very much. I think we are out of time, and there are many other aspects we would have liked to cover. But I invite you to look at the website of the UK Treasury as well as your website, where the terms, the model terms, have been published, as well as ICMA Group website. We have just made an announcement now, and we will welcome comments, criticism, and other suggestions to improve it. How much time will it take us to have this clause to become mainstream? How would that fit among the different other products or instruments? I think I'm